is really residency. So are you a resident for tax purposes, or are you a non-resident of Canada? And tax residency is completely different from immigration. So you can be a non-resident of Canada, but you're still a Canadian citizen or a permanent resident. And so those things are completely separate. But the key thing to remember is that if you're a resident of Canada for tax purposes, you're taxed on your worldwide income. And if you're a non-resident, you're only taxed on Canadian source income, such as dividends and, say, rental property. So that's why it's important to ensure you handle your residency properly. Now, the CRA looks at various different things when they're trying to determine your residency. And this is one of the struggles, is that it's not very clear. And so they look at primary ties, which are, do you have a home available for your use in Canada? Have you left your spouse and, say, children in Canada? And do you have a job available in Canada to return to? These are the big ties. And then there's a whole host of secondary ties: bank accounts, credit cards, club memberships, health coverage, and driver's license. So those are different ties as well that the CRA looks at. You don't have to get rid of all of them. We always recommend minimizing as many as you can, but you don't have to get rid of them all. One other thing that I wanted to talk about is there's a form called the NR73, which is put out by the Canada Revenue Agency. It's a determination of residency form. You're not actually required to fill out that form. And so we recommend never filling it out unless the CRA requests it, or in certain other instances, you have to complete it. But in general, filing the determination of residency form is not recommended. And we've just seen a lot of times where people fill it out. There's a lot of future questions, as you can imagine, and people do it wrong, and it causes a whole host of problems. So you do not have to fill out that form unless requested. The one good thing is that Canada and Thailand have a tax treaty. So a lot of the other ties that I talked about, like bank accounts and credit cards, that's under domestic tax law. And so the treaty trumps it. And so what happens is, if you have a home in Thailand and you're working in Thailand, then under the Canada-Thai treaty, you're more than likely going to be a resident of Thailand and therefore a deemed non-resident of Canada. So it's important to ensure that you're not just looking at things from a domestic point of view. You're taking into consideration the tax treaty, and we see where this is often missed and creates problems for people when they're determining the residency status. So again, keep in mind the tax treaty. So we talked about not filing the NR73 form to become a non-resident, but it's important to ensure you get out of the Canadian system so that they know you're a non-resident. And so you do this by filing what's known as a Canadian departure tax return. Now it's actually the same tax return as a normal tax return, but on the front page, there's a box that says, did you enter or leave Canada? And so say you left Canada June 1st, you need to indicate that you left Canada on June 1st. Because if you don't do that, then the Canada Revenue Agency is going to continue to see you as a resident for tax purposes. So what we often see is people leave Canada, they just file a normal return, and then they stop filing. And so if you've done it that way, then you haven't actually got out of the Canadian tax system. So you need to go back and correct it. Now, there's also certain special forms and implications on the final tax return, such as, if you have more than $25,000 of assets, you need to fill out a special form called the T1161 that only goes with that final tax return. There's deemed dispositions, so it's as if you've sold certain assets, stocks and bonds outside of RSPs on the day you left. So in the final tax return, it's important to ensure that you're dealing with someone who works in the international tax space. We see a lot of times where people just use they do things themselves, or they're using their local accountants that don't really have the expertise in this, and that's when they can get into a lot of problems. For example, if a T1161 is not filed, the penalty is $2,500. So a lot of times we'll see, you know, a husband and wife will not file it, and all of a sudden it's 5,000 in penalties. So again, it's important to ensure that you do the last tax return properly. This year was a very interesting year, as you all know. And so the CRA came out with a few rules around COVID. For example, you know, sometimes people came back in February of last year and they got stuck. They couldn't leave, and the CRA was, or the government was recommending not leaving. And so normally what happens is if you spend more than 183 days in a year in Canada, you're deemed resident for that year. Because of COVID and because of certain specific instances, those days from, I think it was March 16th to September 30th, will not count for the 183-day sojourner rule. So it's just something to consider if you were in Canada because of COVID. So I'll just do a few quick examples. So if you know, you came back to Canada and you were stuck for 6 months or more, the days during that period wouldn't count. So as long as you intended to return to Thailand and you return to Thailand afterwards, then those days won't count and you won't be a deemed resident. Some other interesting situations that we've had from other countries are, you know, say you were living in Bangkok and you went back to Canada only for, you know, you were thinking it was going to be a month or 2 or 3 months, and then all of a sudden you lost your job and you stayed in Canada. In that instance, you know, when does your residency for Canadian tax purposes start? Normally it's when you first go back to Canada, but if you went back for other reasons, for COVID or anything, then maybe we would start it later on. So again, it's just a different filing status this year than we've seen in the past. We've also seen instances where one spouse went to move to, say, Thailand, and the other was stuck behind because they couldn't get in because of local regulations or whatever. And then so what happens? So normally people are, both spouses, their residency is the same. But we've looked at it and said, well, if your intentions were both to move abroad and one spouse couldn't because of whatever reasons, then we may be able to choose different residency statuses. And then again, what if you moved abroad thinking you were going to move abroad for the long term, and you were only abroad for 6 or 8 months and you lost your job and then had to move back to Canada? In that instance, if your intention was to go abroad permanently, then we might still look at making you a non-resident, even if you're abroad for a short period of time. So this year, there's just some different situations, and again, it's important to talk it through with someone who was an expert in this area. So one thing that comes up a lot is, you know, people leave their home in Canada, and is that fine to do? And so typically we say, as long as a home is not available for your use, so if you rent it out, then it's not seen as a major tie to Canada. So, you know, that's typically important. We typically recommend not keeping it empty. You know, because of the Canada-Thai tax treaty, you still can keep it empty and become a non-resident. But again, we recommend, if you can, renting it out. Now, if you do rent it out, it's important to make sure you're filing all of the proper forms. So if you're a non-resident and you have a rental property, all of a sudden you're back in the Canadian tax system and you need to file a tax return to report this rental income. Now, there's a special return called a 216 return that on that form, on that return, you only report your rental income and expenses. And then you only pay tax on the net income. And because you won't have any other income in Canada, that'll be taxed at a very low tax rate, likely 22%. So, but it's important to ensure that if you are renting it out, that you go through all the filings. For example, technically, say you're renting a property for $2,000 a month, you're required to remit $500 a month to the government. Now, if you don't do this, you can be hit with a penalty of $500 per month. Now, what you can do is, say you're renting out a property for $2,000 a month and your expenses are $2,000 a month, You can also file a special form called the NR6, which allows you to remit on the gross income, which is 0, so you wouldn't have to remit anything per month. So it's just important to ensure that whatever you do, you make sure that you're filing these forms. And we have a whole specialized non-resident realty group to help take care of all these things. So if you have a rental property, please feel free to get in touch with us, and we're happy to help with that. Now, if you sell your property, it's important that you go through the proper steps as well. So what you need to do is you need to get something called a clearance certificate. So say you sell the property for $1 million. If you don't get a clearance certificate, your lawyer is required to remit 25 to 50% of the proceeds to the CRA. So all of a sudden you're remitting $250,000 to $500,000 to the CRA. Now, if you file this clearance certificate, what that allows you to do is you can only remit 25% on the gain. So say you bought it for $1 million or $900,000, you sell it for $1 million. Instead of remitting $250,000, you only remit on the gain of $100,000 and only do $25,000. Now you'll have to file a tax return, and it'll work itself out that way when you file the return. But a lot of times people come to us and they're really surprised that all of a sudden they're not getting all their money. And if you sell your property now and the lawyer sends the money to the CRA, you're not getting it back until next June, which is not what people like. So, you know, if you're selling the property, we just recommend, again, speaking to someone well in advance to make sure you're doing things properly. Okay, sorry. Looks like I just got muted there, but I'm unmuted. So amending prior year tax returns. This is one of my favorite things. So sometimes what happens is people move abroad and they think they're a resident for some reason, and they just keep filing tax returns. And then they come to our presentation and they realize they shouldn't have been filing tax returns. And so what you can do is you can go back and amend up to 10 years to claim taxes back that you have paid. Now, technically, after 3 years, there could be, the returns are statute barred, so the CRA does not have to give you the money back. But generally, what we've seen under the fairness provisions, they'll go back and give you 10 years of refunds. And so we actually had one today that we got rectified. The individual kept filing returns when they didn't need to, and we got them back $574,000. It took us over 2 years, I believe, but they were really happy. And we're actually working on 2 other cases of more than $200,000 of refunds. So if for some reason you kept filing tax returns and you realized that you didn't need to, you know, send me an email and I'm happy to help with this. Also, you know, say you left Canada 4 years ago and you just realized that you didn't do the departure tax return, you didn't get out of the tax system properly. We can use that and go back and amend that tax return to get you out of the system properly. So there's no problem going back, correcting anything. So let me talk about a little bit about the voluntary disclosure program. This is for, you know, if you want to go and correct things. So say you've done something wrong in the past and you want to go and correct it, we recommend using the voluntary disclosure program. Now, I'll give you an example. So my grandmother, originally from England, moved to Canada, and she inherited money from her mother, and she kept it abroad. And her accountant said, well, you know, the money's abroad, you don't need to include it on your tax return because it's abroad, which is wrong, because as a Canadian resident for tax purposes, you're taxed on your worldwide income. So I explained this to my grandmother, and she talked to her local accountant. I'm doing her taxes now, but anyways, and then her accountant went and filed 10 years of tax returns to claim the income that she didn't report, and she ended up getting an $80,000 bill. So at first she wasn't very happy with me, obviously, but she did want to do things right. The problem is that the taxes owed were $40,000 and the penalties and interest were $40,000. Now, because her accountant just went and filed the returns, she got hit with an $80,000 bill. Whereas had the person gone through the voluntary disclosure program and said, you know what, this was an accident, I didn't realize that the income should have been included, the penalties and interest would have been waived. Not always the interest, but you can sometimes do that, but at least the penalties would have been waived. So that's why, if you've done something wrong, so you move back to Canada, or if you're in Canada and you realize you didn't report foreign income or there's something wrong and you want to correct it, it's always a good idea to go through the voluntary disclosure program. Now, they won't get rid of the taxes owed, but they'll get rid of the penalties. So again, voluntary disclosure program if you've done anything wrong. All right, so let's talk about what happens when you move back to Canada. So in the year that you move back, you're going to be taxed on your worldwide income from the time you arrive in Canada. So if you move back July 1st, you're taxed on any income you receive after that date. So that's why it's important to ensure any payments you get. So say you're getting a severance payment, you're getting a bonus from Thailand. If you get those after you've left Thailand, and while you're a resident of Canada, Canada is going to tax that income. Now, you'll get a credit for any taxes you paid to Thailand, so it won't be so bad, but you'll still have to include that income in Canada. And because the Canadian tax rate can be up to 53, 55%, it could cost you extra tax. So again, if you're getting any payments, bonuses, stock options, severance, try to get those paid out to you before you go back. Now, if you have any income abroad, that's fine, or you can leave all your assets abroad. It's just important to remember, again, any income earned from that day forward is taxable. So say you move back again July 1st, you have $1 million in a stock portfolio in Thailand. That $1 million is not taxed because that's capital, but any income on that $1 million going forward, wherever that is in the world, is going to be taxed. It doesn't matter if you transfer the cash back or not, that is not taxed. It's just the income that arises on the date you come forward. And now it's important to ensure that you report any foreign assets to the CRA. If you have more than $100,000 of assets abroad, you have to report the assets on a form called the T1135. If you don't do that, then there's a potential penalty of $2,500. And so again, if it's husband and wife, then the penalty is going to be $5,000 a year. If it's a few years, then the penalties can add up quite quickly. I'll give you an example of what happens when you move back to Canada, because there's a deemed acquisition of all your assets on the day you move back. So for example, say you purchased a stock, and it can even be a Canadian stock. So say you purchased Bell Canada at $1,000 when you were abroad, and then you move back and it's worth $10,000. The $9,000 gain that accrued while you're not in Canada is not taxable. And then, so that's as if you bought the stock on the day you move back. So when you come back, it's $10,000. That's the value for any future capital gains. And that's why it's important to ensure you keep a record of valuations of any assets you have on the day you move back to Canada. So for this instance, in this example, you lived abroad, you bought an asset for $1,000. It was $10,000 when you came back, and you sold it for $10,000 and $10,200. There's only a gain of $200. So the tax on that would be very, very minimal. One other thing that I wanted to talk about is global mobility in terms of, if you were working in Canada for your foreign employer. So there's various implications that your income may be taxable in Canada, even if you were being paid from abroad. So if anyone moved back to to Canada or was spent 6 months in Canada or any time in Canada because of the virus, you still need to consider whether or not those days will create a tax liability in Canada. So, we're just seeing a lot of issues. If there's any employers out there for people working around the world, we've had so many situations where all of a sudden people, because of COVID, left Canada and they went and started working in other countries, just thinking, well, it's fine. But the other countries are going to want to tax that person. So a lot of times companies and employees are really being hit with a lot of issues for doing that. One other thing that I didn't talk a little bit about is that there's something called a granny trust. Now, there's not much, in terms of planning, there's not really that much you can do. But one thing is called a granny trust. Now, what happens is, say you inherit $1 million from a relative that doesn't live in Canada and is not going to go to Canada in the future. Now, inheritance is in Canada are not taxed. So initially, say you inherit $1 million and you move it to Canada, Canada's not going to tax that $1 million. Now, say the next year you have a 10% return on your investments and you make $100,000, Canada is going to tax that $100,000 and say you would pay $50,000 in tax. What the granny trust is it says, if you inherit money, put it into a trust. And then what happens is that, and okay, let's go through the example again. So say in this instance, you inherit the $1 million and you put it into a foreign trust and it makes $100,000. As long as that $100,000 is paid out in the subsequent year, it's considered paid out of Canada, paid out of capital, and it's not taxable. So instead of paying $50,000 a year in tax, you can pay $0 in tax. So this doesn't work in a lot of situations. But if you are planning, or someone is going to plan on, will be inheriting money from abroad, and the relatives, and it doesn't have to be your granny, are not going to live in Canada or not going to move in Canada, you may want to consider the granny trust as an option. All right, so let's talk about our services. So what we try to do is we try to speak to people before they leave Canada, just to make sure they do everything right. But we can also help and speak with people after they've left Canada. We prepare, Canadian departure returns for when you leave. We prepare arrival returns for when you come back. We pay non-resident tax returns if you have a rental property. So really anything to do with the expatriate experience, or if you're, you move back to Canada and you have foreign assets, we can help ensure that the assets are reported and there's no issues. So basically anything, again, related to the expatriate service. All right, so that was a pretty quick presentation, but there's only so much tax people want to listen to. So I hope you enjoyed it. Definitely happy to see if there's any questions, and we can go from there. Jen, I know you've heard this presentation many times, but are there any questions that anyone has?
Hello, Jen.
Hello.
Jen?
So if anyone has any questions, they can, I think they can unmute, or they can write them in. All right, there's a few in the chat.
Good morning, Wayne.
How are you?
Good. Sorry, my phone's coming up as Galaxy Note 10. My name is Robert.
Okay, hi Robert. How are you? Do you have a question?
Yes, quick question for you. I departed Canada in 2008. I have no intentions of returning to Canada in the near future. However, my accountant at the time had advised me that I've closed up my affairs. I have a you have to excuse me, I don't know the exact term, but I advised CRA that I've left Canada with no intentions of return. So they're no longer hounding me for tax returns. Yes. However, I was advised that I should continue to keep filing 0 tax returns, which unfortunately I have not done, to ensure that my CPP and whatever I've contributed into the pension fund of Canada will continue to be indexed for inflation. Is that correct?
No, you don't need to file zero tax returns. What happens with CPP is you'll get the benefit based on whatever years you contributed, and the same thing with old age security. So for OAS, you'd have to be a resident of Canada for 20 years after the age of 18 if you continue to be a non-resident. And CPP, you'll get whatever you contributed to. So you do not have to file zero tax returns at all. So.
Okay, thank you so much.
No problem. So Scott has a question. The example of basis bump refers to non-registered accounts, not RSP or TFSA. That's correct. So the RSP is always going to be taxable. So if you pull the money out of an RSP as a non-resident, there's a 25% withholding tax. And the TFSA, because it's a tax-free account, there's no basis bump because you can pull the money out of that tax-free. One thing to remember is it's really important to ensure you do not contribute to a tax-free savings account as a non-resident. We've seen people have big penalties for doing that. For example, people have $40,000 available, and they contribute as a non-resident. Any contribution as a non-resident is subject to a 1% a month penalty. So again, we've seen people do 40,000 contributions, and the penalty is $400 a month. And of course, the CRA doesn't inform you right away. It's 2 or 3 years later, and next thing you know, there's a $12,000 penalty. So TFSA is fine to leave if you contributed while you're a resident, but make sure you don't contribute as a non-resident. So the granny trust, if you're the one that's contributing to so the question is, the granny trust is applicable on expats moving back to Canada if they have been non-resident for many years. If you're the one contributing to the trust and you move back, you can't do it. The contributions to the trust have to come from a non-resident or someone who's not moving back to Canada. Now, if you had a relative who was living outside Canada, and if you gifted them money, and then 2 years later they put it into a trust, that could be one way of doing it. But if you're the one that's contributing and going back, then it won't qualify for the granny trust. There used to be something called the immigration trust, where you could contribute to it for 5 years, and 5 years would be tax-free, but that's no longer. That's been a few years. So
we have a few people raising their hand, so when I mute you, please go ahead with your question.
Good morning.
hello.
Hello.
Yes, do you have a question?
Yes, it's Scrolly calling here from Bangkok.
Okay.
You were saying that Canada and Thailand have a tax treaty.
Mhm.
I just went through about 6 months of back and forth with an NR5 because I just started receiving my Canada pension on an early age.
Yes.
And they were taxing me 26.3%.
Okay.
So in order, they told me that Canada does not have a tax treaty with Thailand. So I went through go ahead.
Yep. No, sorry, go on. Yes. Okay.
I went through this long drawn out 6 month plus back and forth paperwork, document writing with the non-resident tax reduction, the NR5 application.
Yes.
And they finally came back and said, okay, we're not going to charge you that 26.3% anymore. We're only going to charge you 12%.
Right.
Explain that to me.
Okay, so what happens is So your income should normally be subject to 20 to 25% non-resident withholding. Certain income is 15%, depends on the relevant treaty. What happens is you can have it reduced if you file an NR5 form, but in that instance, to have it reduced, you have to file a tax return in Canada every year called a Section 217 return.
Correct.
So they've reduced your income because I guess, so what happens is you can elect to file a tax return. So, say you're making $100,000 in pension income, you would normally just say, okay, I'd prefer to have that tax at 25% and not have my final liability. Because if you file the tax return, the Canadian tax would be higher. But say you only have $20,000 of income, you can elect to file a tax return, and then you get the personal credits and pension credits. So you get $15,000, $16,000, $17,000 tax free. So however they've calculated it, they've estimated that your tax is going to be around 12.5%. And so then when you file a tax return under the 217, it should come out to around there. So that's really why they've done that. I don't know if that was the best explanation, but that's why they've reduced it for you.
Okay, so in the tax treaty, what is the treaty state for non-residents?
So what that does is that reduces the withholding rate to whether it's a 25% or if it's pension income, whether it gets down to 15%. So that depends. But what you've done with the NR5 is you've taken it a step further to request a further reduction, saying that your income is going to be shouldn't be at the withholding rate because you're going to file a tax return.
Okay. Okay.
If you have my email, I can actually send you there's actually a good website that the CRA puts out called the non-resident tax withholding calculator. So if you want to email me, I can send that over to you, and that hopefully might add a bit more clarity as well.
Okay, I'll do that. Thank you.
So Sandra has a question again. What if your income is from pensions and RIFs in Canada? Will that still be taxed in Canada? The answer is yes. So pensions and RIFs will be taxed in Canada, and they'll be at 25% or 15% depending on the income. And again, if you want, you can elect to file a tax return to get some of the personal credits. So if you're retired and that's your only income, instead of having the flat rate withholding, it may be better to elect to file a tax return. So you'll want to look at that to see what makes sense. And again, feel free to send me an email, and I can take a quick look and let you know if it's better to file a tax return or just let the non-resident withholding tax regime kick in.
Hello, Wayne. Good morning.
Good morning.
Hello.
Hello, I can hear you.
Yeah, sorry, I cannot find raise my hand. I don't know what's wrong with my system today, so sorry about that. I left Canada a few years ago. I never filed anything, but I cut all my ties with Canada.
Okay.
My daughter is 17 and she's hoping to go back to Canada to study in university in Quebec.
Yes.
So my question is, in case she needs a student loan,
Right.
what should I do today? I believe they ask, because I didn't study in Canada, I don't know. What should I do today to help her in case they ask for her parents or her mother's tax returns or anything like that?
So that's always a struggle because you don't have to file tax returns, and you shouldn't be filing tax returns. So the only other thing is there's not really much you can do. The only thing is if they ask for proof of income, you can send your contract or something like that, but there's nothing else you can do because you're not supposed to be filing tax returns and you wouldn't want to file tax returns. So
parents with teenagers returning to Canada, is that all we can do? Like just hope they don't ask questions? Is that what it is? Because I don't know, like I believe it's for low income families, correct?
yeah, you know what? And That's not something I'm specialized in. I'm not exactly sure of the implications of student loans or anything like that when one parent is a non-resident, when the parents are non-residents. So yeah, sorry about that.
Okay, thank you.
No problem.
All right, for
Hi,
this
Wayne.
question, we have Caroline.
Hi, Wayne. This is Caroline.
Hi, Caroline.
Yeah, thank you for the very informative presentation. You're getting better and better. I think, you know.
I know. I feel like
It's just-
how many times have you seen the presentation?
Oh, 4, I think. This is my 4th.
Yeah, I know.
Yeah.
Yeah.
Yeah, you're great. Actually, we get
Thanks.
more and more details each year. Thank you so much.
Thanks.
I am now finally going to move back to Canada in
Okay.
2 or 3 months' time, as soon as the COVID situation eases a bit. I haven't been a resident of Canada for 20 years. So what do you think, is there a list that I need to, you know, use to prepare for this move back to Canada as a resident?
Yeah, so we typically recommend having what we call like an arrival consultation, where we go through all of your assets, holdings, timing of payments, and everything, just to plan as much as possible to make sure there's no issues when you come back on the way in. You know, and then even going through things like, you know, yeah, all your assets abroad, and then making sure you apply for the health coverage as soon as you land, because it takes 3 months to get it, but then making sure you're covered on the way in. You know, you're covered in term as well. So yeah, we recommend typically having a call where we go through everything in detail on all your specific situations.
Okay, all right. So I guess I would email you separately to arrange for that.
Yeah, just send me an email and we're happy to arrange for.
And for, I think, everybody's benefit, what would the cost of such a call be?
So how we do things is we do everything in fixed pricing in advance. And so we speak with every single client to get an idea of their specific situations. So it could be $750, it could be $5,000. But what we'll do is we'll make sure we get all of your information in advance, and then we'll send you out the pricing so that there's like no surprises, and it's not like a range, it's like this is the price. So but it really depends again on everyone's situation. Sometimes people have companies, they have rental properties, but we always have a pre-call just to make sure we understand everything. So
Okay, all right, thank you.
no problem.
All right, the next person will be Alex. Please go ahead.
Hi, Wayne.
Hi, Alex. How are you?
Hi. Good. How are you?
Good, thanks.
Yeah, I left Thailand. I left Canada a few years ago and didn't really file anything with CRA. Kind of out of school and came to Thailand and started working. Not really with a preemptive plan to do so, but that's what happened. And yeah, I'm just wondering, is there any limit as to how far back you can go to rectify that, or should I do that?
Yeah, so we recommend doing that just so there's no issues. And so you can go back up to 10 years and file. So if you left, 3-4 years ago, if you file the return in the year that you left, and even if you didn't, we'd recommend just going and filing to get yourself out of the system so there's no issues going forward and there's no questions. So
Okay.
And we do that all the time. So again, happy to help you. If you want to just send me an email, I can let you know how we can go and clear that up for you. So.
Sure. Yeah, I've got your email, so yeah, I'll do that.
Okay, perfect.
Thanks.
No problem. I think there's a question about the CRA expat information to CanCham. I'll take a note of that. Just make sure I forward that on. Anyone else have any other questions or anything? Also happy to share the slides if anyone wants that, or again, if you want to email me any questions, happy to answer that. typically I don't mind if it's a quick question, then we'll, I don't mind answering it. Otherwise, if there would be any fees for fixing things, again, we're always upfront so that there's no surprises, So any good tax structures for pre-immigration to Canada? There are certain corporations that you can set up abroad to Canada, and then they are deemed to have moved to Canada, but there can be preferential tax rates for that. So there are certain structures that you can still do. Typically, you need to have a decent amount of money to do that. And that's definitely a bit beyond this presentation. But if anyone wants to talk about setting up corporations or anything, if they have a decent amount of money and they want to talk further about certain things, then happy to discuss that. So.
All right, if no one have any other questions, I would like to thank you everyone for joining us this morning, and a big thank you to Wayne and Trowbridge for providing us with a very informative and useful presentation. We hope this information you learned today will benefit you in one way or another. And if you have any other questions, please reach out to Wayne directly through his email that is shown in the screen. I'll see you next event. Thank you.
All right, thanks everyone. Thanks for having me.